Skydiving is risky, but people still do it and many are successful at doing it. This is because they prepared and trained for it. They prepared for uncertainties that might happen during the dive. They prepared for scenarios like losing their goggles or parachute not opening. Because of these preparations, they reduce their risk. It's the same with investing. If you are prepared, you can reduce your risk. That's why today I'm going to discuss with you how to prepare to lose money in the stock market. Obviously, I'm not hoping that you really lose money in investments. I want you to picture this. Imagine you invested 100k into the stock market and for a few months, everything was fine. Your 100k turned into 110k and you continue to be invested into the market. The market kept making all-time high. Everything was nice. One fine day, the market dropped 1% in a day. Not too bad. It's just 1%. It's still within your risk tolerance and you shrug it off without letting it affect your mood. The next day, another 1% drop. Still okay. It's just another 1%. It's manageable. It has happened before. And then the next day, a 3% drop. And then a 5% drop. And then a series of 2% drops, 3% drops. In total, you already suffered about 15%. Your 115k now drops to 98k, below the 100k you invested. Unfortunately, this was just the tip of the iceberg. A week or two went by and soon your 98k dropped further down to 75k. For some, it might be too stressful to handle and they might just sell out and surrender. So in today's video, let us discuss how we can be prepared for such situations. Drawdown effect. You have heard that investing will compound your winnings. Obviously, there is no free lunch in the world. Losses can also compound as well. But it's not as straightforward as how gains compound. This is due to the drawdown effect. When you buy a stock for 100 and drops to $90, how many percent did you lose? That is a 10% loss, correct? Now consider this. When you buy a stock for $90, it rises to $100. How many did you gain? That's an 11% gain, correct? Now let's combine the two scenarios together. You bought a stock at 100 and you make a 10% loss. How much percentage gain do you need to recover your initial capital? If your answer is 10%, you are wrong. Now here's where it surprises most new investors. It's not going to be the same 10% loss. You are going to need an 11% gain just to recover back to your initial capital. This is because after your loss, you are starting at a lower base of $90 instead of $100. $90 needs a gain of 11% in order to recover back to $100. This is known as the drawdown effect. This effect will amplify the more losses you make by making it more difficult to recover. Consider a 50% loss. Recovery from this loss requires a lot more than 50% capital gain. In fact, it requires double. It requires 100% capital gain. 100% capital gain is quite a big return that might take a very long time to achieve. Ask yourself, how often do you get a nice 100% capital gain in your investments? So you see, the more you lose, you need exponentially more percentage gains to recover. So do bear this in mind. Do bear the drawdown effect in mind when you're losing money. Know the history. In this section, I like to reference and give credit to Robert Frey, Ben Carson, and Turan Chandra for their research. Before we go into the strategies on how to lose money the right way, we need to be mentally prepared ourselves. Do not worry, I will not tell you that you need to have a strong mindset or some motivational nonsense. Instead, I would like you to take a look at historical drawdowns and their frequencies. This is a chart of the S&P 500 total return for 180 years. Total return means that it includes capital appreciations plus dividend payouts. As an investor, looking at this chart from a bird's eye view, it gives you the impression that it's easy to invest. Your portfolio will go out nicely, uptrend in a predictable straight line. And all you need to do is just to stay vested. Yes, indeed, there is a very nice and steady positive slope of cumulative market returns. The problem is that along the way, there are drawdowns. You have to take losses and it can be mentally stressful. Maybe in this chart it's not too obvious, so let's look at another chart. This is the S&P 500 historical drawdown from 1927 to 2016. You can see there are periods where an investor has to suffer massive losses. In fact, in 1932, there is a huge 80% drawdown. Then in 2009, investors would have to suffer a 50% drawdown as well. As an investor, watching your portfolio go from 100k to 50k is extremely painful. It might be so painful that many start to self-doubt and sell out their position, only to see the prices rise back up. Drawdowns are inevitable and more common than investors realize. Let me provide some more quick statistics. Nearly 2/3 of the time, a portfolio will be in drawdown state. Nearly 40% of the time, the drawdown will be greater than 20%. Drawdown can take a psychological toll, and awareness of the likelihood of such drawdown can assist investors in making prudent investment decisions and managing the psychological impact. So now that we know the historical drawdowns of the stock market, what can we do to be prepared? There are 3 important tips that I'd like to share. Dollar cost averaging. Firstly, we can use a dollar cost averaging strategy. This is the easiest strategy of all. Dollar cost averaging is a strategy whereby we buy a small portion of the market every month. This spreads our purchase over long periods and averages our costs. The advantage is that because most of us receive our paycheck every month from our jobs, our monthly salary cash inflow can match the monthly investment contributions. Secondly, it prevents procrastination. Some of us just have a hard time getting started. We know that we should be investing, but we never quite get around it. Mostly, this is due to fear of the risks involved. Another advantage of dollar cost averaging is that it also minimizes buying regret. This is because the investor constantly makes multiple small investments, regardless of market condition. It will eliminate the temptation to try market timing strategies that usually do not succeed. Plan ahead for market declines. If you fail to plan, you plan to fail. To navigate the uncertain markets, we need a sound plan for the market downside. We need to make a plan what to do when the market declines. A 10% correction is very common. What do you do when the market goes down 10%? What about 20% or 30%? I do not have a magic number to give you because this decision is very personal. Some people cannot sleep well at night when the market drops just 5%. Others are able to stomach a 40% decline. It differs from people to people. The key thing is this: you need to plan ahead. What exactly would you do when the market declines to a certain level? Perhaps you like to rebalance your portfolio by moving out of stocks to bonds when the market drops 15%. Perhaps you like to take this opportunity to buy more stocks at a cheaper price. Or perhaps you plan to dollar cost average and just continue to do it all the way down. Whatever it is, make a plan and stick to it when the market tanks. This way, you are prepared for the nasty scenarios when they unexpectedly come your way. Using auto stop loss. Now that you made the plan, you need some tools to help you execute it. You might plan to sell your positions when your stocks drop to a certain point. This is where stop loss order comes in handy. Are you using a broker that allows stop loss? If not, you need to change to another broker that can provide this feature. This feature is usually free. You only have to pay your broker after the order is triggered and executed. Stop losses are important so that you will be disciplined and not procrastinate when it's time to sell. Stop loss orders with your broker will be executed instantly when the condition is met. This is important because you will want to take action as soon as possible before liquidity disappears from the market. Most of us probably hold a full-time job. We have our daytime commitments and it's not possible to always monitor the market. We need to attend meetings and we have deadlines to meet at work. The stop loss order allows our broker to monitor the market on our behalf so that we can go about our daily lives without any disruptions and have a peace of mind that our portfolio is well taken care of. It won't cost you extra, so be sure to use it. Agree or disagree with the video? Subscribe, leave a like and comment down below, and I'll see you in the next video.